Do you want to learn how many trucking companies and transportation organizations are lowering their risk and making more money? That's what we're talking about today. We have Van Carlson. He's from SRA 831b.com, and he's a risk manager that specializes in controlling transportation risk. That's next on the Trucking Risk and Insurance Podcast.
Welcome to the Trucking Risk and Insurance Podcast.
Welcome, Van. Thanks for joining us here on the podcast with Chris and I. So, you've got an interesting term that I can't say that I've heard of before. 831B. What the heck is 831B? Is that? It's obviously not my plane seat. I know that.
Well, you hope not, right?
Yeah.
That's a big plane. Here it is. It's part of the U.S. tax code, right? Have you heard of 401ks? 831B, all that. So, everybody's kind of, got the terms captive insurance out there. There's a macro captive, which, we see a lot of our trucking companies utilize that through traditional channels. And then there's a micro captive. And a micro captive is really the smaller captive arrangements. Congress passed a tax code back in 1986, and it was the 831B. And basically what it is, create an incentive for business owners that were self-insuring risk or taking on more first dollar risk when it comes to their traditional insurances and all that stuff. And we call that an unfunded liability. And basically what Congress provided was, if you're going to have an unfunded liability, how do you want to fund it? Risk financing, right? All that good stuff, all these terms that we throw around as insurance geeks, I guess we'll call each other. Do you want to use pre-tax dollars or after-tax dollars? And the 831B, all that allows you to do is, as you fund an 831B plan out, very similar to 401k, so you're expensing it at the operating company level. This entity, this 831B, has its own tax returns electing under the 831B. So it's a C corp and all those other structures, and no different than a traditional macro captive is, right? It's a C corp, right? So this is a C corp as well. As long as you stay under the threshold of the premium contributions and you meet the qualifications, there's a 4-part test, there's regulations and all that fun stuff. You can defer that inside the C corp, meaning that the premium is not taxable income. So now you're utilizing tax deferred dollars to fund that risk financing versus after-tax dollars. And the best example I give you guys is really the PPP here in the United States, where, obviously Congress got together and the executive, and we printed up $6 trillion of make-believe money, threw it out to the business owners. Now, they did that because there was no business interruption on traditional policies were going to trigger that, as we know, right? I mean, you guys probably know the stats better than I do, but in March of 2020, had traditional insurance covered those claims under business interruption, it would have been $440 billion just that first month. And in the United States, we collect about $260 billion at that time. I think the number's gone up because of rates, but we collected about $260 billion in all lines across the board in the United States in any 1 year. So, the solvency of those insurance companies would have been tested immediately. So the point there is that the insurance is never going to cover these types of risk. Right. When it comes to being, from the political risk standpoint, if you want to call it that, or just simply saying from the health issues that go on in our country today. Or in the world for that matter. So that's really where we kind of spun up. And we've been doing this since 2008 due to our great recession we had in the United States. I saw business owners that were they knew leverage. They knew how to grow their business through debt. They bet every year was going to be better than the previous year based on the current tax code of the United States. Accelerated depreciation is an incentive to spend money and create velocity of dollars that we need in order to get our GDP running, right? So unfortunately, I saw a lot of my clients that when I was selling traditional insurance go out of business. And I was exposed to this idea of self-insuring risk, utilizing an 831B tax code from an RV manufacturer. And that's really where the light bulb went on for me, that all business owners should at least understand this. And It is a tool in the toolbox. Yep. There's rules and regulations to it. And where we fit in is the administrator of these plans, no different than a 401k administrator is.
Right.
We want to make sure
so before we go too much further, let's tell our audience who the heck you are and why you know so much about this, because we jump right into the 831B, which is
Yeah,
great. Thank you very much for that. But yeah, let's let our audience know who's
yeah,
Van Carlson and what the hell does he know about 831Bs?
yeah. So I kind of hit on it already a little bit. I was a property and casualty agent, ran a pretty successful agency leading up to '08. Top one producer, all those good things, and had plenty of plaques on the walls and all that good stuff. But
Yeah.
um, I was introduced to the idea early on, didn't find it really appealing, for the clients, trading pennies to dollars to self-insure didn't make any
Right.
sense. But as an agent, the guy that sold these things, half the time I was telling my clients, hey man, if you turn this in, it's not going to be covered, and here's why. Or hey, if you turn it in, here's the outcome that's going to happen to you. And so I realized there were business owners were self-insuring risk. I just think it came home to roost really in '08, '09 for me. And that's really when I decided to make a pivotal change in my company. Other than that, I pride myself on being an entrepreneur, quite honestly. I own four other operating companies. I love to hunt and fish. I live in Idaho. And I recently become a papa, and there's probably no better thing
Oh,
than having grandkids.
yep.
Yeah, I tell people it's one of if you haven't had him yet, it's you still got one of the best things to look forward to in life. Is what I tell
Yes.
people. So,
Agreed. Agreed. Well, congratulations on that. I'm one as well. So
yeah,
yeah.
yeah. Well,
So
And damn,
I
I'm
think you
probably
can almost
younger
match with
than
Santa Claus right now. I'm thinking if they're the way you got the beard growing.
yeah.
yeah. So
That's
what
a
the
good beard.
831B is a tax deferral program. How is it managed? Like if I put money into this,
Mm.
am I self-insuring some of my risk?
Yes, yes.
Gi-
So
I was going to say, give me an example of how I could use it.
yeah, so
Mhm.
we're dealing with a lot of trucking companies specifically
Right?
on first dollar losses when it comes to commercial auto liability.
Mhm.
I mean, I've got trucking firms in Texas they're on the hook for the first $250,000.
Right.
Right.
So
They've had claims.
how does this fit in then?
Well, that's an unfunded liability. So, which means now until he hits the first $250,000 of that claim, he's on the hook for that first $250,000, right?
Right?
Directly out of
So,
pocket.
right. And so what we'll do is we'll do an 831B up just to handle that risk alone, just to handle that loan. Now, he may have high deductibles on his comp and collision too on the vehicles as well, right? So, and then some of these guys won't even turn in claims, right? If it's less than $25,000, they'll just eat it. So the question is how, it gets back to that question: do you want to use cash flow, which is after-tax money, which is retained earnings in a company, or do you want to use pre-tax dollars, dollars you would have sent off to Uncle Sam in this case, to build up those reserves and surpluses in order? Our tagline: we embolden business owners through innovative risk management. That's what we do as a whole. And so from our point of view, what I've seen, when you start to do these types of programs as business owners, it clicks. They'll literally go and they'll take on more risk. Why? Because they have the appetite for it, because they got these dollars piled up in the back room. So now to offset their premium cost, have more of an appetite to take on more first dollar risk, right? Or first dollar loss, excuse me. So those are things that we do specifically in the trucking firms just to offset what's happening currently in the marketplace.
So
Um, that's what
if
we're
I
doing there.
if I have a $250,000 deductible and I'm using before tax dollars to fund an 831B, I can then withdraw some of that money
It's an
and
So this box has to look and feel like an insurance company.
right.
Mhm.
So there's a
So I
so
file a
you would
claim.
you would submit a claim. Yep. So we as administrator would adjudicate the claim. We run through the process. We assess that, obviously make sure that, and we actually hire an independent adjusters, no different than you guys would
Mhm.
experience any other insurance carrier. I mean, there has to be that process to it. And then basically it comes down to a reimbursement. So if the client's out a deductible, he can get reimbursed by his 831B. And that's where he's being made whole, right? So now, let's, for example, some of these guys may say, I got the wherewithal to take on one, two, three of these things, right? Which is a substantial amount of money.
Mhm.
But what happens if I got four? What happens when I have bad underwriting years where I'm
Mhm.
getting really hit hard? Or snow, the things of the world of chaos, right? Um, that's where it really can start to affect the business owner, the trucking owner itself. And that's really where, you know, I always tell clients, if you have a good underwriting year, you got to maximize that. How do you maximize that? If you have a good underwriting year, then you've had good profits as well. I mean,
Mhm.
pretty much correlate, in my opinion, based on what my experience with the trucking industry is. That means, and you need to put some of that away in a tax deferral basis because we know the bad years are coming. I mean,
Mhm.
it's just
Mhm.
the fact of life, right? So.
It's cyclical. That's for sure.
Absolutely, and it's by company, you're right.
Yeah.
I mean, it's the economics of it is one thing. I've had clients that had no claims in 4, 5, 10 years, and then boom, they get 3 in 1 year, and they're like, "What? What
Mhm.
happened?"
Yeah.
And then they really find out if they really have the risk tolerance to do to bite off on some of the risks they've taken, right? So
Right.
it makes it more palatable to do it through an 831B, is
Sure.
what
Sure.
what I've seen. So.
Yeah. Is there any um, particular or preferred fleet size that works better with this program at all, or it can be from one truck all the way up, or what?
One truck would be tough.
Okay.
It really, and here's a couple things we didn't get into. There's a distribution of risk. There's a pooling of risk. If I don't, if the trucking firm doesn't have more than 32 risk exposure units, which means between the tractors and trailers, if he wants to insure the cargo, there's other things we do in there that we can look
Right.
at. But I got to have enough exposure units to where I can say, okay, you've got pooled risk, meaning a claim can't happen all at once. Meaning, for example, collision is a good example. Not all your trucks going to be involved in the same accident at the same time. So I got distribution of risk. One of the things the IRS has challenged these things on is when you don't have the rule, the law of large numbers. As we know, insurance is that way, right? So
Mhm.
what we'll do sometimes when the firms are small enough, and this is across the industry lines, not just the trucking industry, we'll actually create a pool, a blind pool, we call them, where you may be pooled with other people, and a percentage of your
Mhm.
premiums in are at risk that are unaffiliated to you.
Right.
And that's some of the risk clients take on when they do these things. Now,
Mhm.
if you're a big enough trucking firm and you've got north of 25 units of between tractors, or shouldn't say 20. If you have 25 tractors and you got trailers and you got cargo, and we can build out your risk exposure, and we can also show that you have distribution risk because not everybody can have a claim at the same time, and
Mhm.
comp
Mhm.
becomes a little questionable if you have all your
Right.
trucks and a tornado comes through and blows them out of a yard or whatever, right, or
Right.
damages them in the yard. But beyond that, we start to look at the distribution of risk, and that's a key component of what we do as an administrator because we
Mhm.
want to make sure our clients stay compliant. And it's one of the things that probably rubs business owners, or what do you mean I got to cover other people's claims?
Mhm.
Well,
Mhm.
this thing's not risk free,
Yeah.
guys.
Yeah. Yeah.
So
Well, again, a captive is usually of a model of group of companies, and
right.
everybody shares in that. So at the same time, you want to be cognizant of who your neighbor is in that program, and you don't want to invite in the guy whose losses are always 150%.
Well, and the nice thing is they're dealing with reinsurance carriers, right? Where they got to
Yeah.
watch the premiums, everything else. We're doing it. We got a limited risk here because honestly, it's
Right.
set to their deductibles or set to their
Right.
to make that gap up, right?
Mhm. Mhm.
Some guys might just take cargo insurance on their own, depending on what what they're responsible for. And we see that more and more going on just because the cost is becoming
Mhm.
kind of
Mhm.
cost prohibitive,
Sure.
unfortunately.
Sure,
So.
sure. What are is there limits, like, or a limit, I should say, as to how high you
The
can
most,
go?
yes. So, a couple things. When the code was first passed in 1986, it was $1.2 million is the most you can put into this thing.
Okay.
There were some issues with the code. It got hijacked for estate tax planning. I tell people, the Boston Tea Party was a real thing. Americans hate paying taxes, and so if there's a code out there that's a benefit to the taxpayer, some smart law firm somewhere is going to figure out another way to utilize it that really
Mhm.
wasn't intended for.
Right,
And it's part of our innovation. It's
right.
what we do. But anyway, uh
Well,
got abused. They've cleaned it up under the Path Act in 2017, and they got rid of some estate tax planning. But what they did do is they increased it by another $1 million and put a
oh,
CPI increasement on it. So now, and by the way, both aisles, Republicans and Democrats, are a believer in this program. It's
mhm,
a great safeguard for small business owners specifically,
sure.
to utilize this. I mean, that being said, so now you're at 2.8. We got an inflation. We're at $2.8 million. Now that's the max you can put into.
Right.
There still has to be a methodology to your premium, meaning,
Right.
actuarials tied to and all that kind of stuff. So, and you guys are familiar with that.
Yep.
And
Yep.
if your audience isn't familiar with it, I think everybody's in your industry, in the trucking industry, I think has some knowledge of captives.
Mhm.
I would think so, but just know that, there is some, there is a cap, and also, there's some methodology. Just because you can put that max
Mhm.
in, it doesn't mean you get to.
Right,
Um,
right,
yeah.
right. Well, it's basically you're funding a program. It's. I like to look at it as layers of an insurance program, right?
Yeah.
So you've got multiple insurers in the game. Your deductible per se is you're insuring that portion. So if we said you had $25,000 deductible, you're insuring that program, and then if your reinsurance goes up to 2 million, you have an insurer there. If it goes 2 million to 5 million, you have
Yeah.
another reinsurer again.
Yeah. The
So,
layers. Yeah.
right. So this gives you that ability that the larger you are and the larger amount of risk you want to take on, you can take and put that through this program. So if I said, "Hey, I'm going to self-insure to $1 million with my insurers," I could be looking at the 831B here to do that first $1 million for me.
Yeah. And typically in those scenarios, we allow up to 3 years to fund up to that. And then once you get to
Right.
that limit, you're not, I
Yep.
mean, it's one of these things that you're just not going to, once the exposure has been covered, although you have to pay premium every year in order to get the
Right.
policies and all
Right.
that stuff. But,
Correct.
again, these are the details of the deal. Just know that there's things that we regulate on.
Mhm.
You can't just keep piling money up in this thing and not have claims,
Right.
for
Right.
example. And and if you don't
Damn.
have claims, you're not going to be able to put money into it. So
Right.
those are things that those take about 3 to 5 years to show
Yep.
themselves, honestly. But
Sure.
that's true about any underwriting.
Yep.
This is a new idea. This is a new concept for the business owner going in. And I will tell you guys, we're the largest manager of these plans in the country.
Mhm.
And we are going international. I'm speaking at an international conference in
Cool.
Miami, actually,
Yep.
this month.
Yep.
Talking about, because the same thing that's going on in the United States is going on all over the world,
Oh,
obviously,
yeah.
when it comes
Yes.
to,
Yes. Yeah.
we
Well,
we
yeah.
tell clients, you're paying more and getting less today when it comes to your insurance program. Doesn't matter
Right.
what business you're in.
Yes.
I was going
Yes.
to say you're
Exactly.
paying more and getting less in groceries. So why should
Mhm.
insurance be any bloody
Mhm.
different?
Mhm.
So
Mhm.
Now,
true.
Yeah.
let's, what states do you operate in? Or
Oh, all
are
of
there any limits?
no,
Oh,
no,
Yep.
damn.
no.
Well, because I talk to insurance brokers or agents, and of course, usually they're quite regionalized, the state or two. But
Mhm.
you're saying you can do this in all states.
Yeah, and just so you guys know, I mean, we work with a lot of insurance brokers. Unfortunately, we're getting a lot of phone calls out of Florida right now. It's funny.
Right.
I literally I was on a news broadcast last night with Tampa Bay.
Yep. Yep.
One of our medical doctors down there, in Orlando. She lives in
Yep.
Tampa, but in Orlando, she didn't have any damage, but her practice is locked down for the last,
Right.
since the hurricane, and she still doesn't have power and electrical.
Yep.
Insurance isn't triggering it, and she has business interruption going on. So we've
Right.
actually insured that business interruption for her. So
Cool.
she's able to put a claim against her own dollars now and bring it
Right.
back into her operating company, because her payroll didn't go away, her rent didn't go
Yep.
away, her
Yep.
loans didn't go away. I mean, all those things kept coming.
Yep.
Very very similar to, unfortunately, COVID, right? So,
Yeah. Exactly.
um, yeah, so
Yeah.
that's what's going on there. But yeah, if we're getting a lot of calls right now for property casualty, it's because they got to find an answer. And,
Yeah.
and here's what I tell clients: this is not a silver bullet. You're going to
Mhm.
have some risk in this thing, meaning that,
Mhm.
if you want to partake, you're gonna, if you're not big enough, you're gonna have to share in risk in other pools. But I
Right.
think, honestly, I think we do a really good job with that, and we have like-minded clients. And by the way, we share in our clients' claims,
Mhm.
so it makes us fairly unique. And I think, if everybody wins, if you win, I should win. If
Mhm.
you lose, I should lose, right? I mean, that's
Mhm.
kind of the way I want to run my business. We're consultants, but we're at the same time administering your plan.
Mhm.
We charge fees for that, obviously, but if you start to have claims, we'll push our fees back to you, because, we want to make sure you stay in
Sure.
business, quite
Yep.
honestly.
Yep. Yep. Exactly. Well, and it's interesting because here in Canada we have a number of captive programs and in various lines of business as well. Transportation is top of mind with a lot of trucking companies
Oh
at
yeah.
the moment. Now, the obviously different jurisdictions, different rules and whatnot. So here in Canada, there is no federal type setup for this type of program. It is all based on provincial. And at this moment, we currently have two provinces who are set up to do, how do I want to say it, on the ground captives. Every other
Like
province has
domicile.
to
You
go
can
offshore.
domicile your. Yeah.
Yeah.
Okay.
So
Yeah.
so that which does make it a little more difficult and a little more aggravating for some folks, but there are a number of how do I say service providers out there for offshore captive programs and whatnot.
Yeah.
So it's not difficult to put together. But I know a lot of people are going, "Gosh, I wish, particularly in Ontario, I wish they'd get it together so we could just have a domiciled captive here in Ontario like they've done in Alberta and BC." But eventually it'll get there. So.
I think the market's going to dictate it. I honestly, I don't, when I first got going on this in '08, there was 8 states promoting you to own their captives in their state domicile.
Mhm,
There's
mhm.
now 34.
Yeah.
And so, and they do it for revenue. They do it for premium
Sure.
taxes. They do it for all those other things. I mean,
Yeah.
it becomes a passive taxable event to them that's
Right.
not necessarily hitting all their constituents. Right. So,
Right.
um, and guys, we do it a little differently.
Yeah.
We use a federally recognized tribe here in the United States, so we don't go offshore with our clients at all.
Mhm,
There was a law passed in '97 that if it's a federally recognized tribe,
mhm,
First Nation, as you guys know them in Canada,
mhm,
um, you could form a company on their tribal land,
mhm,
and
mhm.
do it, and you get an EIN number, employer identification number, right?
Yeah.
And you do a federal tax return. All these vehicles do pay taxes. So they pay taxes not on the premium that's submitted, as long as you elect on an 831B, which you do pay taxes on is the investment income, realized
Right.
investment income. So if you have dividends or you have a money market account or something like that on those reserves and the surplus of those plans,
Mhm.
you are going to pay taxes on those
Sure.
every year at the
You
corporate
will.
rate.
Yep.
So
Sure. Oh, exactly. Yeah.
yeah. Well,
Cool.
yeah. I keep
Well,
forgetting you guys know a lot about CAFTA, so I apologize. There's a lot of guys
That's
on
all
here.
right. That's all right.
no, you got to remember though. Well, John knows more about captives than I do, quite honestly. I know something, but many of our listeners, this may
Yeah.
be a
Yeah.
brand new subject to them. So, what else do they
Very
need
much
to
so.
know about about 831B that you haven't said yet?
Honestly, the flexibility it gives business owners today, we're utilizing the first people to adopt these things were Fortune 500 companies, right?
Mhm.
Okay.
I mean, they're the first ones to adopt macro captives, right? I mean, and by the way, they don't care about the deduction so much. And by the way, I even know insurance carriers that will utilize 831Bs to isolate risk. Like let's say you're in a high protection class 9 and you got a lot of market exposure to that. Well, you may want to take some of those premiums, put them in a subset of an 831B to not pay taxes on those dollars as a traditional insurance company, but isolate that risk and build up that, because that's a lot of risk you might be taking. So I see a utilization of this code in a lot of different ways that we've worked with. We do a lot of stuff with warranties. I have a ton of auto dealers that sell service contracts.
Mhm. Mhm.
We pump a lot of the money into the 831Bs. It becomes a huge revenue source for them on the outside. Quite honestly, it's good underwriting. It's very profitable. That's why you get asked to, everything you buy today, being asked about a warranty, right? A service contract warranty. I get a kick out of Amazon. I think I ordered something today this morning for $65, and the thing flipped up that said, "Hey, do you want to protect it?" I'm like, really? But anyway,
Only if it's funded by SRA.
yeah, I mean, I guess
Yeah.
some people would. I mean, I don't know, but
Yeah.
anyway, but the bigger ticket items, and we see a lot of
Mhm.
trucking firms too that are selling their
Yeah.
Peterbilt, their service contracts. Those guys are doing the same thing. And so,
Mhm.
just because you're hearing about this for the first time, a lot of your listeners just
Mhm.
know it's been around for a long time. And
Yeah. Yeah.
and it used to be a big boys club tool, quite honestly. It used to be an institutional tool. Again, when I got involved in '08, I wanted to price this product to my clients. Pigs get fed, hogs get slaughtered, and quite honestly, there's been a lot of hogs in this industry. I mean, they're asking too much, too many fees, too much. But when there's competition and there's more people like me coming to the table, like we've done, you should drive costs down, right? And that's kind of what we're seeing right now. So
Mhm. Yeah.
Oh,
Yeah, 'cause I know from the Canadian perspective, um, we've had a few captive programs going on in Canada for a few years now, but it's still in its infancy stages compared to other lines of business. Like you're
Mm.
saying there, you know, um, property management, liability, and whatnot for some of the big guys. It's been going on for years.
Oh yeah.
So,
Yeah,
and
especially the auto dealer guy. I mean, yeah,
Yep.
anyway, so in the construction guys, I mean, these guys are
Hmm.
paying so much money in premiums, and if they run a
Yeah.
good if they got good loss controls, experienced workforce,
Yeah.
why do they need to subsidize
Yeah.
other bad
Yeah.
their competitors that are not as well educated or better safe training and all that good stuff. So no, I think it's a great tool for the right client. And again, it's and what I'm finding is more and more people are not. I would say 10 years ago you probably didn't have nearly as many people as willing to take on more risk today,
Hmm. Hmm.
but I think they are, and it's not because they want to; it's because they have to.
Hmm.
now, Van, describe from a trucking company point of view or somebody in transportation, describe your ideal client. What size are they? Which could be stated either by fleet size, revenue, whatever it is that thing. What is it that you're looking for in a transportation company? Who's ideal?
I would say five trucks or more. They start
Wow,
to it
that's
starts to
small.
pencil.
So just about
Oh yeah,
everybody.
Hmm.
yeah. Honestly, it starts to pencil pretty early, and it's not because our fees and the way we structured it, the client wins, right? I mean, that client has to win. Meaning,
Hmm.
meaning this. At the end of 5 years, he calls no joy and says, "Hey, I want to get out." Because it's a C corp, he's going to be taxed at long-term capital gains versus ordinary income throughout the operating years of his company. Based on his fee structure, he'll come out and win on that, right? I mean, that's one of the things that makes the IRS upset, right? There's some tax arbitrage on that, but at the same time, there's a ton of risks these guys take on, and in my opinion, the smaller you are, the less likely you can take on some of that risk
Hmm.
financially. Um,
Hmm.
and you guys probably see that. I mean, it's
Hmm.
Yeah.
it's not like these guys are getting big point breaks on their units because they're probably paying the highest premiums they're going to pay when they're 5 to 10 units per unit, right? I mean, it's just you're not getting those price points until you get a much bigger fleet.
Right.
And
Right.
meanwhile, you're still taking on the same amount of risk those fleets are taking on.
Hmm.
And
Hmm.
from what I see,
Yeah.
so
Well,
Absolutely.
resources have a lot to play into it as well, right?
yeah, and exactly. I mean, I would tell clients if you can't do more than $80,000 in these plans every year, you probably shouldn't do it. Quite
Hmm.
honestly, it doesn't pencil. But if you're doing that kind of a thing, and you know, uh, if not today, eventually, right? I mean, hopefully, you become more successful with time, and you're going to look at tools like this because it's just going to become part of your overall risk management strategy. Quite honestly.
And hey, insurance is required by law. So if you don't watch the pennies, as we know,
Mhm.
so hey,
Yeah.
I would encourage your contact info is in the show notes down below. So if you are interested in finding out more, reach out
Mhm.
to SRA and Van, and he'll be happy to answer your questions. Van,
Yeah.
last word.
Yeah.
Did we
You
cover
know, I
everything that was needed?
Yeah, I think so. I mean, like this, the devil's in the details, and again, business owners, any business owner owes it themselves to educate themselves on any of these,
Right.
do their own due diligence, really understand this thing. We
Yep.
do a good process. I think we do a good job in educating clients, and we tell them the good, the bad, and the ugly of it. Right? This is not a silver bullet by no means. It helps. At the
Mhm.
same time, I think you owe it to yourself to look into these types of tools because as business owners, we take a lot of risks to do what we do. And if I can help mitigate those risks, and then maybe embolden business owners to take on more risk because they have a way to handle that more effectively and efficiently, all the better for it's a rewarding part of our business, quite honestly.
Yeah.
Yeah. Thank you
Well,
guys. Really appreciate being on the platform.
and thanks for sharing all that with us, Van. Your info is in the show notes down below. For those of you who would like to reach out and learn more about SRA and the 831B in the States, please contact Van, reach out, and he will be very happy to give you the information. Information is money, and saving money is how you stay in business. Thanks so much. That's it for this week on the Trucking Risk and Insurance Podcast. John and I appreciate you. Don't forget to click the like, subscribe, listen for that ding, and of course, please leave a comment down below.